Good afternoon, everyone, and thanks for joining today's webinar, How to Trade Credit Spreads to Generate Consistent Income with OptionsPlay. My name is Scott Green, Marketing Director with eOption, and shortly I'll be introducing our presenter who does all of our OptionsPlay webinars, Tony Zhang. In today's webinar, we'll be going over what are vertical spreads, who should trade credit spreads, when to trade credit spreads, credit spread management, and more. For those unfamiliar, OptionsPlay is highly integrated with your live trading platform, and it helps you with analysis, strategy, and research for trading options. Once I introduce Tony and he goes over credit spreads, we'll have time for Q&A at the end. If you have any questions along the way, please use the chat box in the webinar platform or the Q&A box. Go ahead and submit your questions at any time, and we'll get to as many at the end as we can. I just want to share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. We will be sending out a link to the recording after the webinar in the coming days. It is a holiday week, so it might either be the end of the week or early next week by the time we get it out. But if you've registered, you will be receiving a recording of this webinar. So where you can find this tool, OptionsPlay, it's on all live trading accounts. It's a tab across the top there. You should see a tab called OptionsPlay. Again, it's for on live trading platforms only. And if you do not have a live trading platform or live trading account, I should say, just click it's easy to sign up. Just click the open a new account on our homepage, the green button up top, and there click live trading, and there's a form you can fill out. If you have a live trading account, you can take advantage of OptionsPlay. And eOption is among the leaders in low commission rates, where we offer $3 per stock and option trade and 15 cents per contract. You'll get access to great tools and customer service, great for high volume traders. And now I want to introduce our presenter, Tony Zhang, the Chief Strategist at OptionsPlay. Tony has many years' experience in the financial services industry, and he oversees the OptionsPlay development team that has led to the creation of some of those innovative tools in options trading and analysis. OptionsPlay is their flagship product and what is integrated in the platform. It's also within several major sell-side brokerage firms, and there's a direct-to-consumer platform as well. And Tony helped create and build up this product suite, bringing it to market, and he has developed and managed many of the firm's partnerships as well. So with that being said, I want to hand it off to Tony.
Thank you, Scott, and thank you everyone for joining me this afternoon. Welcome back to our Options Education webinar series. Today we're here to talk about credit spreads. I think this is a pretty timely topic considering what we're currently seeing in the markets, a lot of volatility, which tends to be better for credit spread trading. So really good time for us to discuss this strategy. We're gonna break down what credit spreads are for those of you that are brand new to options trading. For those of you that have experience trading, what we really want to make sure is everyone understands the best practices for credit spreads. There are a lot of different ways to trade credit spreads. We want to show you based on our back test what seems to provide better returns against what a lot of what we're seeing is being traded. So this is a very popular strategy. A lot of people tend to chase high probability trades with credit spreads. So we really want to make sure that people understand, number one, what is the basis behind the strategy? Why should you trade it? More importantly, when should you trade it so that you are entering these correctly? And then lastly, what I want to address is the volatility question, because I see a lot of people trade credit spreads simply because vol is high. But I want to point out that may not necessarily always be the best opportunity. So I want to address a lot of these things during our webinar. For those of you that are brand new to OptionsPlay, welcome. This is a tool that's designed to make your options analytics and trading experience as easy and intuitive as possible. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. I'll spend about 15 to 20 minutes going through the slides, showing you best practices for trading credit spreads. But what I really want to spend the most amount of time on is using the actual tool that you guys have access to here at eOption that's free of charge to all live accounts, and show you how to utilize the tool to look at credit spreads and find opportunities and analyze them correctly so that you know that you're trading the right strategies for the outlook that you have on the underlying stock. It's really important to understand what are the ideal situations for selling credit spreads, because I do see that some users are using them in cases where perhaps other strategies may be better suited for their directional views. So those are the things that we're going to address here today. I'm going to go through these slides relatively quickly. We're going to go through what are credit spreads for those of you that are brand new to this strategy. I'll talk a little bit about how they're constructed and what to do. I'll talk more importantly when to use credit spreads. I think that's actually one of the most important pieces to take away for those of you that are already trading credit spreads, to understand when are the ideal times to use this strategy, and then how to trade them, how to trade these effectively. So this is really talking about, from our back test, what different types of credit spreads you should trade, what deltas you should be looking at, what expiration dates, even what symbols may be better for selling credit spreads. We'll go over all of those things. And then lastly, I'll talk about credit spread strategy management, meaning once you're in a credit spread, once you've sold that credit spread, how do you manage that trade correctly? Those are some of the things that we're going to talk about. And then lastly, we'll jump over to OptionsPlay. I have a few symbols to look at in this current market environment, some opportunities that we're going to take a look at and analyze together so that you guys have some ideas as to how to do it on your own. And the important piece is really being self-sufficient and being able to use the tools that are available to you at eOption so that you can analyze these trades correctly. So number one, when we talk about what are credit spreads, there's two types of credit spreads you can trade. You can trade a bullish credit spread, which is a bull put spread, or a short put vertical. And there's a bearish credit spread that you can trade, or a bear call spread, sometimes called a short call vertical. So these are the two strategies. These are the two strategies we'll break down. I'll talk a little bit about the rationale behind each one, how they're constructed, and then that will help us understand a little bit more on the next few slides. So before we get started, the first thing to remember is that these strategies are limited risk and limited reward. And the reason that I really like trading limited risk and reward strategies is more so from a perspective of managing a trade. Now, once we're in a trade, a lot of times we're not just managing the trade, we're also managing our emotions. So when you trade a strategy that has limited risk and limited reward, you know what the max potential that you have on the trade is and what the max reward is before you get into a trade. What that means is that it really allows you to plan ahead of time to know what is your best and worst case scenario for a specific trade. And that usually makes when you're in the trade a little easier to handle, because you already know what the best and worst case scenario is, and it's easier to say I have a plan and to be able to trade that plan. When you trade other strategies that have unlimited risk or unlimited reward, it's really difficult sometimes in the middle of that trade, while you're down on that trade or making some money on that trade, to pull the trigger and to decide when to cut your losses and take profits. So with limited risk and reward strategies, usually those rules are pretty simple and they're usually easy to follow. So that's why I like trading them, and hopefully I can show you some of the benefits of these strategies. Now, to show you how they're constructed for those of you that are brand new, I'm going to use a fictitious stock XYZ trading at $100. So in this particular case, we have stock XYZ. We're bullish on the stock, meaning we think it's going to go higher. How can we trade a credit spread in order to take advantage of that? So right now we're talking about the short put vertical, which is the bullish credit spread. How it's constructed is it starts off by selling a $100 put. So selling a $100 put on its own as a naked put is technically a bullish strategy, meaning if you're bullish on the stock, you can sell a 100 strike put, and that will allow you to collect, let's say, $4 on that trade. Now, the reason that we don't necessarily want to go out and just sell a $100 put for a full $4 credit is because selling a put does have unlimited downside risk. If the stock goes to zero, you lose up to $96, basically $100 minus the $4 credit you receive. Now, usually you don't want to risk $96 to try to make $4, and that's why we want to trade credit spreads. So in order to limit the risk that we take on this credit spread, what I'm going to do is I'm going to buy a $90 put, a lower put below for $1. And what that's going to do is that's going to limit my risk so that even if the stock drops below $90, I don't lose any more money. So here I've received $4 credit for selling the $100 put. I pay $1 to buy the $90 put to limit my risk. So that means my net credit here is $3. So that's my max reward. On a credit spread, your max reward is the credit that you receive on the spread. Your max risk is what's left of the width between the two strikes. So the distance between the first strike and the second price strike, a $100 put and a $90 put is $10. So if I'm collecting $3 out of those $10, the remaining left is going to be my max risk, $7 in this particular case. So I'm going to risk $7 to try to make $3. Now, a lot of times that doesn't sound very good. However, this strategy will be profitable as long as XYZ stays above $97. So basically $100 minus the credit that I received, as long as the stock stays above $97, this strategy will be profitable. That's really why these strategies are popular, because they're quite forgiving. Even if we said that we're bullish on the stock XYZ at 100, any other bullish strategy, the stock needs to go higher in order for you to make money. In this particular case, even if the stock goes lower, even if it goes to $99, you'll still make some money on this trade. That's why it's such a forgiving trade, and that's why a lot of people like to trade it, is because even if your directional view is very loose and the stock doesn't really move in your favor, even if the stock stays at 100, you'll still collect your $3. So that's why this is a very popular strategy. If the stock goes above 100, you'll make the $3. If it stays at $100, you'll still make $3. And even if the stock goes a little bit lower, you'll make a little less than $3. The only time you lose money is if the stock goes below $97. So you have a lot of room to make money on this particular trade, and only if the trade goes severely against you, where the stock goes to $95, $93, $90, that's when you lose the full $7. The stock really has to go all the way down to $90 or lower for you to risk your $7. So that's a bullish credit spread. A bearish credit spread is basically the exact opposite. Same thing, let's say we take stock XYZ trading at $100. In this particular case now, we're bearish on this trade. So what can you do? So you start off by selling a $100 call. This is, if you sold a naked $100 call on a stock that you're bearish, you would collect the $4 credit that you received by selling that $100 call. However, to sell a naked call has unlimited risk. If, let's say, the stock shoots up to $150, you lose $50 minus the $4 you received in the credits. You're risking $46 if the stock does really take off. That's not a risk that most people are comfortable taking. So in order to cap that risk, you can spend $1 and buy, let's say, the 110 call. And what that does is it caps your risk so that now the net credit here is still $3 because I've sold the 100 call for $4. I bought the 110 call for $1. My net credit's going to be $3. So my max reward, just like the other one, is going to be $3 as well. And because the distance between the two strikes, the 100 and the 110, is $10, that's going to define my opportunity. So whatever's left from the max reward is going to be my max risk. So whatever the distance between the two strikes, you can think of that as the opportunity. Whatever you collect in your credit, whatever you collect in credits, the remaining is going to be your risk. Now, this also is a strategy that's very forgiving, because as long as stocks XYZ trades below 103, you will make money on this particular trade. So even if the stock doesn't move lower that you expect it to, even if it stays at 100, you're still going to collect your $3. If it goes up to 102 or 103, you're still going to collect some money on this particular trade, just not as much. And the only time you risk $7 is if the stock shoots all the way up to 110 or higher, above that higher strike. So this is, again, a very forgiving strategy. It allows you to take a loose directional view and profit as long as the stock doesn't go severely in the opposite direction. And that's why, again, it's a very popular strategy amongst traders. Now, this strategy, generally speaking, tends to work a little better on ETFs and index options versus individual stocks. And the reason for this is because ETF and index options tend to have less gaps. They tend to have less big moves, which is what works against a credit spread if that big move happens to work against you. And the other reason is because even when you get a big move to go in your favor, you have limited risk, you have limited reward on this particular trade. So you don't really make any more money, even if you call the direction correct. That's why credit spreads tend to work on strategies, tend to work better on instruments that don't move a lot. Instruments that move a lot, tend to work in your favor in other capacities through other strategies like debit spreads. Now, because credit spreads are a option selling strategy, you want to sell relatively short dated options when you're selling credit spreads. Usually 2 to 5 weeks out is where we see most credit spreads being traded. And the reason, again, is because short dated options maximize theta. You want time decay working in your favor when you're selling credit spreads. So to do that, you usually do that by selling shorter dated options. And when it comes to strike prices, you almost always will sell out of the money credit spreads. You will almost never sell anything that has an in the money option for a credit spread. You always want to start with an out of the money strikes when you're selling credit spreads. Now, you have a lot of choice as to how far out of the money you sell credit spreads, and this is really where the variation comes on the strategy, and I tend to see a very wide variety of credit spreads being traded. So you can trade strikes that are relatively close to the current price, or what we call near the money, and these will typically have lower probabilities of profit, but it comes with better risk to reward. And in the next slide, I'll get into some of the metrics behind what lower probability profit and better risk to reward looks like. And then some of you will like to sell very far out of the money credit spreads. We see a lot of these types of trades. We see a lot of 100, 200, 500 lot trades on really far out of the money credit spreads that have extremely high probability of profit. And I know a lot of people like to look for high probability of profit because that sounds really good. However, it's really important to understand that the trade-off on that is you're going to get really poor risk to rewards. And I think I'm going to illustrate this in the next slide here, because I tend to see a lot of people ask me, how do I find high probability trades, as if high probability trades is somehow the holy grail of trading. And the answer is that it's not. You really should not just focus on high probability of profit, because when you're trading any type of option strategy or any type of trading in general, you are really trading off two things: probability with risk to reward. Anything that has high probability will always have really poor risk to reward. Anything with really high risk reward will have really poor probability. You never want to only look at one side of the picture, because if you do, then you're missing the entire other half of the picture. It's really important to look at both sides of the picture. So to put some numbers behind this, when we're selling credit spreads that are near the current price, so near the money options, you typically will see credit spreads that look something like 67, 70% winner, something in those types of range, 67% probability of profit, and they'll usually have something like a 1 to 2 risk to reward ratio, where you're risking roughly $200 to try to make a $100 credit on a credit spread. So this is where you're selling credit spreads near the current price. And then what I see a lot of traders trade is very far out of the money credit spreads, 90% probability of profit, sometimes even 95, even 98%. I see a lot of these traded. However, these are traded off by really, really poor risk reward. And it's really important to understand that, because you're collecting, let's say, $100, and it sounds really good that you're going to have a 90% chance of collecting those $100. But when you're wrong, you're risking a lot of times a lot more than $900. So here's just, a lot of times you'll be risking $900 to try to make $100. But what I actually see a lot of times is people risk $2,000, $3,000, $4,000 to make $100. And that's really where things get a little screwy. When you get into those types of numbers, all it takes is one bad trade, one big move in the markets like we've seen over the last few weeks, and people have been wiped out of their entire accounts. A hedge fund recently just went belly up this week that were selling really far out of the money nat gas cover. They were selling naked calls, which is part of their problem. They didn't have cap risk. They were selling naked calls, and nat gas really exploded because of weather patterns, and they went bankrupt literally overnight. So this is some of the risks that we typically see when you sell these really high probability of profit trades. Make sure you understand what is the risk on the backside of that, because a single trade could wipe out all of your account, if not a lot more than what you have. So keep that in mind. Be careful when you're selling those really high probability profit credit spreads. So now that we've kind of understood a little bit between how to construct credit spreads and the difference between selecting different strike prices, what I wanted to show you guys is, based on our research, what the optimal credit spread looks like. And this may not be what you guys want to hear, but this is based on historical research over the last about 7 years worth of backtesting on credit spreads. We see that the optimal credit spread to trade is selling the 50 delta call or put, meaning the short leg is basically selling an at-the-money call or a put. And then when you're buying back is roughly a 25 delta call or a put against that to help you cap that risk. And what you're going to generally see is that the credit that you receive on that credit spread is roughly going to be about a third of the distance between those two strikes. So what that translates to is most of these will have roughly about 67% probability of profit on these types of trades, and you're roughly going to risk about $200 for every $100 in reward. And what we find is that it's really important to have risk rewards that are reasonable, because once you get into that risking $1,000 to try to make $100, we always see blowups that kind of basically wipe out all the gains that you get from having 95% probability of profits. These blowups happen a lot more frequently than statistics tell us. You know, based on statistics, we should only have 2 to 3 standard deviation days a year, but we've seen 8 this year already. So statistics, you know, these types of statistics are not working from this perspective, and that's why it's really important to limit your risk and make sure that your risk is really no more than 2 to 3 times what you're collecting on a credit spread. If you're risking any more than that, you're going to have a few blowups that's going to just wipe out all of the gains that you have on the previous 10, 20, 30, perhaps even 100 trades. And that's really what we are hoping to help you guys avoid when you're selling credit spreads. So just as a point of reference, if you're selling a credit spread and the width is $3 wide, you want to try to collect roughly about $1. If you're collecting significantly less than $1, then that means you're selling really far out of the money credit spreads, which means that you have very high probability of profit, which sounds really good, but it comes on the trade-off with really poor risk reward. And we see that over the long run, that strategy does not work out very well. And I just have a reference point. If you're selling a $5 width, $1.67, $10 width, $3.33. These are the types of credits that you want to look for when you're selling these types of widths. And I have these widths up here because these are fairly common widths that you would use if you're selling your credit spread. So now that we talked about how to construct them, more importantly, really the relationship between probability and risk reward, which I think is probably the most important aspect for anyone to learn when they're on this webinar. And what is the optimal expiration date and strike price for selling credit spreads? Now let's talk about when should you actually enter a credit spread. And this is really a very important thing, because I actually see a lot of misuse sometimes with credit spreads. So it's really important to understand that credit spreads are most efficient when you're expecting a neutral or modest move, meaning you're not expecting the stock to make a big move, but you're fairly sure that the direction, you have a fairly fair amount of certainty of direction. So this is really common for those of you that use technical indicators when it's overbought or oversold. Because when something's overbought, you have a pretty fair amount of confidence that it's not going to continue going much higher. When it's oversold, that's when you have a fair amount of confidence that it's not going to continue going any lower. I think the markets today is certainly what I would classify as oversold. we are definitely more than 2 standard deviations, if not 3 standard deviations below average right now with the huge sell-off we've seen over the last few weeks. So usually in these types of conditions, we have a fair amount of certainty or a high probability that the stock market or a specific stock may not continue moving any lower. These are the types of times that you want to utilize credit spreads. Other times is double tops, double bottoms. So effectively, if you've identified that a stock is unlikely going to go higher because it's hit a double top, that's a good time to enter a call credit spread. If you have a double bottom and you're fairly certain that that stock's not going to continue moving any lower, that's a time to sell a put credit spread. But I want to emphasize that you do not want to sell credit spreads when you expect a large move. So if you expect a stock is going to bounce 5% higher or 10% higher, or break out because you think it's going to move, it broke out of a trading range and you think it's going to move 5-10% higher, don't trade credit spreads. Even if volatility is very high, don't trade credit spreads because there are much better ways to deploy your capital. You should be trading debit spreads or buying a call or a put. That's going to be able to allow you to take advantage of a big move. Credit spreads don't allow you to take advantage of a big move. I'll give you some examples of this when we jump over to OptionsPlay. So just as a reminder, if you're bullish, you want to sell the put credit spread. If you're bearish, you want to sell the call credit spread. So I just want to do a quick illustration of a chart to kind of help you guys better visually understand when is the best time to enter a credit spread versus some other strategies. So here's a stock that's been trading within a pretty tight range between 101 and 103 for quite some time. And I have the stochastic indicator here at the bottom that identifies overbought up top and oversold here at the bottom. And whenever you identify the stock is trading in a small range and it's not moving a lot, that's an ideal time to use your overbought and oversold indicators to say basically when it's overbought to sell a call credit spread, when it's oversold, sell a put credit spread. You don't even have to wait for the call credit spread to expire before you enter the put credit spread. You can basically string these along. And as you can see, in the very short amount of time, you have a lot of trading opportunity to sell a put credit spread, call credit spread, put credit spread, call credit spread over and over again. So credit spread traders tend to trade the same symbol over and over again versus when you're expecting a large move to happen on the underlying stock. Sure, you can sell a credit spread here, a put credit spread, and it will make profits if the stock moves higher, but the profit you receive is going to be limited. And in the case that it doesn't move higher, and it does move lower, you're going to risk a lot more money to do so. Not an efficient way to deploy your capital. You're much better off entering a debit spread that gives you a lower probability of profit, but when you're correct, you're going to make 2 to 3 times what you're risking on a trade. And that's what you're going to be able to take advantage of a large move. That's a much more efficient deployment of your capital. Something that we don't necessarily always think about, but something you really should be focusing on is, am I deploying my capital efficiently for the outlook that I have on the stock? If my outlook is simply that it's fairly neutral, I don't think it's going to move much lower, or I don't think it's going to move much higher, sell a call credit spread. Sell a credit spread. If you think the stock's going to make a big move, look at debit spreads instead. We have a whole webinar just on that one topic alone. So make sure you take a look at that when you are expecting a large move in the underlying stock. So let's now talk about, once you're in a credit spread, how do you manage it? So with any form of trading, risk management absolutely is key to long-term success of a strategy. So when it comes to entry, we already talked about this. We want to enter them with tops and bottoms. Whenever we expect the stock to no longer move any higher or move any lower, that's an optimal time to enter a credit spread. You can string calls and puts together. You don't have to wait for one to expire before you enter the other. So you really can trade a lot of these credit spreads on the same symbol over and over again. So that's how we talk about entering a credit spread. When it comes to exiting a credit spread, this is really where it differs a little. So number one, the goal of selling any credit spread is to let it expire worthless and for you to keep the full credit. So in the example that we gave with stock XYZ, where we collected $3, the goal is to keep all $3 and simply let that call expire worthless. However, when it comes to cutting losses, this is really where it gets a little, it depends. And it depends on how much premium you're receiving with respect to the vertical width. So we talked about trying to collect 1/3 of the vertical width. So if you're collecting anything greater than 20% of the vertical width or 1/5 of the vertical width, you want to cut your losses when you've lost anywhere from 75 to 100% of the credit that you've received. Now, for those of you that like to sell really far out of the money credit spreads with really high probability of profit, you're going to receive less than 20% of the vertical width in the credit. So for those types of trades, when you're selling high probability of credit spreads, you want to cut your losses when you've lost anywhere from 1 to 200% of the credit that you receive on that credit spread. So managing credit spreads does take a little bit more work because it depends on how much credit you receive. If you stick to our, what we find is the optimal credit spread, then you only need one rule. But if you do trade those high probability credit spreads, make sure you adjust your stop loss numbers accordingly based on that. So with that, what I want to do is I want to jump over to eOption. I want to show you guys the tool that you guys have access to, OptionsPlay. You can click on the OptionsPlay tab here in the upper right-hand corner to access it. If you don't have access to it because you don't have a live account, you just have to open an account to see this. And you can always call your account representative to help you get set up with that. We created OptionsPlay really to make options trading and analytics a lot more easy, a lot more intuitive. Because if you look at an option chain, sometimes it's really difficult to compare buying a call to a call spread, or compare one call vertical to another call vertical. So if you're trying to select a credit spread, sometimes it's difficult to figure out exactly which strikes you want to choose. And maybe you're not even sure which expiration to choose. So there's a lot of work that it requires to work on an option chain. We wanted to make that experience a lot easier. So for those of you that are brand new, we wanted you to start exploring and looking at options without feeling overwhelmed by the option chain. And for those of you that have experience trading options, this is really designed so that you can compare multiple strategies side by side, modify them really easily. So if you need to make adjustments, quickly do that, and be able to see the resulting positions and have the analytics to help you decide definitively which strategy is best suited for you. Now, I'm going to pull up Apple. And I'm only going to pull up Apple because this is the stock that everyone's looking at. I want to remind everyone that the opportunity that I'm presenting right now is purely for educational purposes. This is not a recommendation to buy or sell any securities. And I'm bringing up Apple because I'm sure this is a stock that everyone is paying attention to right now. Many of you probably own some of this stock. So this is something I want to present as a possible opportunity. I don't think it's a good idea to catch a falling knife, which is where we kind of are right now. But if we see a bounce tomorrow and we kind of see Apple recover a little bit above 182 or 180 rather support level, then perhaps that's an indication that Apple may be bottoming out, and that's an opportunity to potentially get into a put credit spread, because I certainly think Apple is quite oversold here. I think by all measurements of momentum, as you can see on the stochastics, it's reading 11, which is extremely negative. So let's take a look at some put credit spreads rather on Apple. And I want to compare it to a debit spread to kind of help drive home the point is that if you're expecting a large move, credit spreads is not the trade to make. So first off, what I'm going to do is I'm going to create this, I'm going to get rid of the long stock here. We don't want to compare stock right now. We want to look at selling a put vertical. I'll do one for, let's say, December 14th, the monthly one, which expires in about 3.5 weeks. And let's take a look at maybe a $5 wide spread. So I'm going to sell the 177.5, 172.5, which is $5 wide. We said that for a $5 wide credit spread, I want to collect 1/3 of that, which is roughly $1.67, which is really where I am right now. I can even maybe look at the 177, 170, $7.5 wide. I want to collect 250, so I'm collecting 265 there, 1/3 of the distance between the two. So here is a credit spread that I can trade. Here is a call that I can buy and a debit spread that I can buy. And what I'm going to do is I'm going to compare these three and show you guys the difference and show you when you should utilize the credit spread and when you should use other strategies. So before I do that, I'm going to first make sure that I'm selling the same number or risking the same amount. So let's say I'm willing to risk $2,500 on this trade. Whoops, 2,500. So now, as you can see, I can sell 5 contracts of the credit spread, buy 2 calls, or buy 3 debit spreads. So here, what I'm going to do is I'm going to use the P&L simulator. This is really the crux of what's going to help you decide what strategy is best for you. The reason we created this is because if you buy a call option and you're looking at an option chain and you think Apple's going to go up 10%, how do you know how much money you're going to make on any of these selections? And the answer is you really don't. The best thing you can do is possibly get a back of the envelope estimate, but that's all it is a back of the envelope estimate. What we want to do is show you how you can definitively know which strategy is best suited for you. So that's where our P&L simulator comes into play. So I'm going to take a look at the December 14th expiration. So what happens if Apple stock, let's say it bounces a little higher back to 182 and just sits there. So if the stock bounces and just doesn't move any lower and is at 182 at expiration, which is about 3.5 weeks from now, as you can see, if I had sold the call credit spread, I make a $1,300 profit. This is exactly when the type of opportunities that you want to take a look at a credit spread for, is when you feel that the stock's not going to continue moving any lower, but you're not really sure it's going to bounce much higher. You're fairly neutral on it. Conversely, if I bought a call option, I actually lose $50. And if I bought the call spread or the debit spread, I make $77. So obviously out of these three, I'd rather make $1,300 than any of these two. And remember, all 3 strategies have the same amount of risk, because I've already used our risk and investment calculator to say I want to risk no more than $2,500. So if I'm going to risk $2,500 and the stock stays at 182, I'm going to take the strategy that makes me a $1,300 profit versus virtually break even on these 2 strategies alone. And what you can do is you can use our P&L simulator to say, well, what happens if Apple stock goes a little higher? What happens if it goes to, let's say, 185? So let's say the stock goes to 185. So that's a little higher bounce that goes back up to, or not much higher actually, basically where it closed yesterday. If the stock goes back to 185, same thing. Credit spread gives me a $1,300 reward. Call now looks a little bit more interesting, but not enough. $400 profit on the call, $617 on the call spread, the debit spread. So now, again, as you can see, if the stock stays exactly if the stock goes to 185, still better off trading the credit spread. So this is how you can definitively know which strategy is best suited for you. And now what happens if the stock really does rally back up to 196, which I actually think is probably not a crazy idea. But let's say it goes back to 196. Now, as you can see, the credit spread, again, maintains only a $1,300 profit. And this is why the credit spread is not an efficient way to deploy your capital if you do expect any sizable move, because you're going to be capped in your risk at the $1,300 credit, versus the call option will give you a $2,300 return. So $1,000 more on the call option than the credit spread, and the debit spread gives you a $2,400 profit. So if I think the stock's going to bounce up to 196 by December 14th, I'm probably going to trade this debit spread. And conversely, if the stock goes any further, you can see the difference between the strategies. So now if I think the stock's going to go to 210, which is probably pretty crazy, but it was just there a few weeks ago, I'm going to make a $5,000 profit on the call option versus still only a $1,300 return on the credit spread. So again, an inefficient way to deploy your capital if you do expect a large move. And that's why we always teach, if you expect a large move, don't trade the credit spread, even if volatility is really high. Because I know a lot of users have been taught, hey, when volatility is high, sell credit spreads. So that is certainly true, that when volatility is high, that credit spreads are ideal. However, what I tend to find is that when you do expect a large move, do not trade the credit spread, because no matter how much vol comes down, you're not going to be able to make up for the fact of what you're not going to be able to make off of delta. So keep that in mind. This is how you can utilize our tool to quickly identify your different opportunities. So setting up a debit spread versus a credit spread versus a call option, or any other strategy really for argument's sake. And use our P&L simulator and say, well, if the stock stays exactly where it is, how much money do I make? If the stock goes higher, how much do I make? And more importantly, if the stock goes lower, how much do I lose? So this is really where you can test out all of these strategies side by side and see exactly what your expected return is, what your expected losses are, to make you an informed decision as to exactly what to trade. And also at the same time, it really allows you to plan for your trade. So you know, hey, worst case, the stock plummets, I lose $2,400. The stock really takes off, I make $2,300 on the call versus the vertical. So this really allows you to know what your possible scenarios are ahead of time, which makes managing your emotions while you're in that trade a little easier. So I'll just take a look at one other example here. Let's look at the Qs. Very popular, I think, ETF right now. Certainly with the technology shares down so much, finally broke below a major support level around 160. Let's just call it the 160 support level. It closed at 196, 159.16. So, but this does look quite oversold again, similar to the Apple stock. Actually, I already have the indicator here. So as you can see, stochastics, not as oversold as Apple, but certainly still in that oversold territory. So, you know, if we do see a bounce tomorrow, that may be an indication that this move lower is near, it's near exhaustion. I think today's volume wasn't particularly high. So when you get these type of gaps down with not a lot of high volume, those tends to be sometimes be a bit of an exhaustion gap. And maybe tomorrow we see a recovery. And if that's the case, maybe we can take a look at some bullish trades. You can, again, use a credit spread as an opportunity. So same thing, I'll do a credit spread here. I'll change it to the December 20, let's say the December 21st expiration, 31 days away. So basically 4 weeks. Yeah, let's look at the December 21st. And let's look at maybe a 5-point spread. So like I said, 5-point spread, I'm trying to collect roughly about $1.66. So what you can do is you can just basically move the price sliders down until you get roughly $1.66. That's one of the ways that I like to find credit spread. So here, as I can see, the 158.5, 153.5, $5 wide between the two. I'm going to collect $1.64, which is roughly a third of the width. That's how I'm going to find my optimal strikes. And compare that to buying a call or a call vertical if we do see a bounce higher. Same thing, I'm going to normalize this and say I want to risk, let's say, $2,500 on this trade. So I can sell 7 contracts of the credit spread, 4 contracts of the call, or 5 contracts of the debit spread. So now let's compare the strategy. So the Qs are at 159. Let's say I think that it's going to at least recover back to 160 before on expiration, which we said is December 21st. So as you can see, if the stock stays at 160, I'm going to collect $1,148 on the credit spread. I'm going to lose $900 on the call option. I'm going to lose $849 on the debit spread. So very clear. If I think the stock's going to stick where it is and not move much lower, but not also move any higher, credit spread is going to be much better for me in this particular scenario. And I bet even if the stock moves a little bit higher, I'm still probably way better off on the credit spread. And you can actually use the slider to get a sense for how much does the stock need to move before other strategies start to make sense. So as you can see here, as I move the slider up to about 166, that's when this strategy here on the right starts to outperform this credit spread. So I can go back to my chart and say, where's 166? 166.5 is about right here. So do I think in about 1 month's time, do I think this will go back to 166? If I do, I'm probably better off trading the debit spread. If I don't, I'm better off trading the credit spread. That's how you can make a much better decision as to what's the most efficient way to deploy your capital, as opposed to just looking at volatility, because volatility is only telling you a small component of the P&L of each one of these trades. Because as you can see here, even when volatility decreases, the difference in profitability is maybe $100. And I'm talking about a massive move in volatility. I'm talking about $100 difference versus if the stock just moves even a couple of dollars higher, I'm talking about almost $1,000 difference. So from 166 to 167, it went from about 1,100 to 1,600. So a $400 difference just for a 1-point move versus probably less than a $100 gain in volatility, even if there's a massive move in volatility. And that's why we don't want to optimize your strategies based on volatility. You want to optimize your strategies based on delta or your outlook on the underlying stock. And the tools that we provide here are designed to allow you to quickly say, if I think the stock's going to recover to 172, well, how much expected profit do I actually have? How much risk do I have if the stock goes against me? I'm risking the same amount of money. So what I'm really looking for is, if the stock goes to my desired outlook, where am I going to get the best return for my money? And that's how you're going to be able to make that comparison. So with that, I want to thank everyone for taking the time out this afternoon to listen to us, understand more about the credit spreads, and most importantly, really showing you guys how to utilize these tools so that you can analyze your own credit spreads and really see, am I deploying my capital efficiently by using credit spreads? And making sure that you know what are the right opportunities to enter this type of trade. So with that, what I'm going to do is I'm going to open this up for Q&A. I'll stick around and answer as many questions as I have time for. It looks like I have a few questions already queued up. So if you have any questions, please type them into the chat window or the Q&A window, and I'll answer as many questions as I can. So Christopher, regarding your question about stock twits, that's a slightly off topic here. So if you have a question regarding that, please email me at info@optionsplay.com, and I'm happy to answer your question regarding stock twits. How many various credit strategies exist? So every other credit strategy is really a variation of what I just taught you. So everything stems from a naked call and naked put, and then you add on to that the credit spread, which is a limited risk strategy. And then you have iron condors, iron butterflies, which are basically just combining the call credit spread and put credit spread into a single strategy. So they're all just variations off of the same strategy. I thought that you could ask to lose a lot of money on credit spreads if it goes in the money. Not sure what you mean by that, William. If you could clarify for me on that, I'm happy to answer your question. How did you get stochastics on the chart? Please, thank you. Great question. So on the chart, there's an expand button. On the chart, you have a studies button, and you can add any of the studies that you want to your chart. Do you do adjustments? Not sure what you mean by that. I'm guessing you mean adjustments to your strategy. So here's my philosophy on adjustments. You usually adjust because you're losing money on a trade. And my philosophy is that if you're losing money on a trade that you're uncomfortable with, the best thing to do is close out that trade and reevaluate if you would enter a new trade if you weren't already losing money on the existing trade. If the answer is yes, then close out the trade, then adjust, and basically think of it as a brand new trade. You're not adjusting an old trade. So the question to ask yourself is, would I make an adjustment if I wasn't, the question to ask yourself is, would I enter a new trade right now if I wasn't already in a trade? If the answer is yes, then just close out the old trade and enter your new trade. If the answer is no, then don't make any adjustments, just close out your trade and take the loss and move on. So that's my philosophy on risk management. And that's more of a philosophy on risk management than it has to do anything with adjustments or your option strategy at all. Because you don't want to throw bad money, good money after bad money. Make sure that you manage your risk correctly. And the best way to do that is using these types of limited risk strategies. What do the options play scores tell you? In your examples, you were picking trades with lower scores. So the options play score is simply telling you the risk to reward of a strategy. And you shouldn't let the options play score dictate everything that you do, because all it is telling you is how well balanced that risk to reward and probability is. So I talked about in this particular slide that all trading is a trade-off between risk to reward and probability. If you're only looking at one of the two, you're only looking at half the picture. We created the options play score to give you an idea as far as how well balanced these twos are. But at the end of the day, no matter how well balanced something is, that doesn't guarantee you profits. And no matter how poorly balanced something is, that doesn't guarantee that you're going to lose money. So it's just one piece of the decision-making process that you have to make. So as long as you're comfortable with the risks and rewards that you see on the P&L simulator, the OptionsPlay score is more of a guide to give you an idea as far as are you trading something with at least reasonable risk reward and probabilities of profit. And one part of the reason that we created the OptionsPlay score is because we tend to see a lot of people do stuff like this. They'll say, oh, I think this thing's going to be bullish. Instead of paying, let's say $5 for an at-the-money call, I can pay $1 and buy this really far out of the money call. But in reality, yes, you can pay a lot less to buy this far out of the money call than what you would do if you pay in the money call or an at-the-money call, but it has a very, very low probability of profit. And that's why you get a really low OptionsPlay score. So think of the OptionsPlay score as a way to help guide you away from bad trades. It does give you an idea as far as which one of these trades are best. But when you see three strategies that have relatively similar scores, I would say you always want to use the P&L simulator to help you guide you to which trade's actually optimal for your outlooks. I'm assuming you can compare credit spreads with anything identical except expiration dates. Yeah, absolutely. You can compare any strategy that you can construct. You can add puts, calls, whatever you want to do with it, you can do. As long as you can construct it, you can compare it. That's the power of our platform. If you can construct any forward-like trade, you can use it and take our P&L simulator and see exactly how they would perform. Can you show the screen on OptionsPlay for iron condors? Sure. You can click on Modify, use the same strategy constructor, click on Neutral, and let's do short iron condor. And now you have an iron condor. You can do the width, you can do the wingspans, you can move the strikes up one or down one just by the click of a mouse. This is all designed to make your process of finding an iron condor as easy as possible. My only take on iron condors is that I would never trade an iron condor because we just said that a call credit spread is bullish, a put credit spread is bullish, a call credit spread is bearish. So to trade an iron condor is basically saying I'm bullish and bearish at the exact same time. And from my perspective, I don't know of any indicator that tells me that a stock is both bullish or bearish at the exact same time. And that's why I don't believe in trading iron condors. I do believe in trading a put credit spread today if I'm bullish, and if tomorrow I'm bearish and I want to trade a call credit spread, I can enter a call credit spread, and combined I make an iron condor. But I don't believe in entering iron condors as a single strategy. Other people may have different opinions on that, but that's my opinion on iron condors because I just don't know of anything that's going to tell me that something is bullish and bearish at the exact same time. Any other questions? Kevin, you're very welcome. How debit spreads is different from bull credit put spread? It's completely different. So first of all, you would pick completely different strikes. As you can see, when you're trading a bullish credit spread, you're selling out of the money puts. When you're trading a debit spread, you're buying out of the money calls, which it's just a completely different strategy. We have actually done a webinar on differences between debit versus credit spreads, and I highly recommend you to take a look at that, where we get in depth difference between the two. Really important to understand. They are very, very different strategies. I don't even think it's worth comparing buying a debit spread to a credit spread because there's a completely different rationale that you go between trading a debit spread versus a credit spread. And I think my chart here illustrates that. When you're selling credit spreads, this is the type of market opportunity you're looking for when you're selling credit spreads versus this is the type of market opportunity that you're trading when you're trading debit spreads. William, are these webinars archived? Yes, all of our webinars are archived for you to view. Scott, if you don't mind sending the link to the recordings in the chat window, we'll send everyone a link so that you can get access to that. Is there a set of instructions for using OptionsPlay and how to find things and what to do and what things mean? Great question. So we have a button here on the upper right-hand corner that's called Guide in OptionsPlay. You can click on that if you want to know what the OptionsPlay score is, what the technical score is. So all of that is included to you in the Guide button on the upper right-hand corner. Any last questions? If there's no more questions, I just want to thank everyone for taking the time out this afternoon. I hope you guys have found this webinar useful in helping you guys better understand this strategy. Really, it's not an easy strategy to understand. So take the time, watch the recording if you're brand new to the strategy, learn a little bit more about trading spreads. Hopefully this helps you understand, why you should consider looking at limiting your risk when you're selling these types of, when you're trading options. It's going to be really useful in helping you guys succeed in trading when you trade limited risk strategies, because we never know what's going to happen. As you've seen over the last few weeks, I don't think any one of us would have predicted the market's going to move this violently, this quickly. By selling credit spreads, no matter what happens, you have limited risk, and that's really the key to long-term success with trading. So thank you, everyone. I hope you guys have a great afternoon, and I will see you guys in 2 weeks. Exactly 2 weeks on Tuesday, we'll do another webinar. So thank you so much, and I hope you guys have a great afternoon.
Okay, thank you so much, Tony. A lot of great information as always, and taking us through the credit spreads and answering all the questions. And thank you to everyone who's attending, and thank you for our questions, or for your questions. We really appreciate your participation. And if you have any more questions, please reach out to the eOption customer service team. Here's the number. And here's the email address that you can reach out to. And please reach out to us for anything else. Again, the OptionsPlay feature is available for live trading accounts and on the live trading platform. So if you don't have one, please sign up today. If you have any questions, let us know. Thanks again for attending, and everyone have a great rest of the day.